Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Welcome to this episode of the Australian Finance Podcast. Today you're going to be hearing from Scott from Everest, and we're going to be answering your financial planning questions. We've got questions on superannuation, buying commercial property, how to find a good accountant, and so much more. We're also going to talk a little bit about the business that Scott has built with Alex over at Everest. So Scott, thanks for joining me.
Thanks for having me on. Great to be here.
First time on the show.
Yep.
And
hopefully not last.
Hopefully not the last. We'll let the audience decide that. No, I'm sure we'll be fine, mate. And in Melbourne, because you've got a bit of a team here.
Yeah, so we've just opened up an office about 4 months ago in Melbourne, and really excited to come across for the first time. Had my second girl 5 months ago, so it was the first chance I got to come across, yeah.
Yeah, that's great, mate. And congratulations.
Thank you.
Imagine a few sleepless nights, but maybe it's a good chance for you to be here and get some sleep.
Yeah, definitely. There's no late nights or any boozing going on. It's just, very, very much value the sleep.
Yeah, just some girl dad sleep. Why not, mate? So this is your first time on the show. We've had Alex on the show plenty of times, even Daisy before as well. Maybe just in like a bit about you. Do you want to take us back in time to maybe why financial planning, like why you became a financial advisor? I'd love to know a bit more of that origin story.
Yeah, cool. So it kind of felt like probably a lot of people with their careers kind of fell into it, to be honest. So probably going back to 18, when I was 18 and finishing school, wanted to be a famous soccer player and did the trip to the UK to try out with West Ham and a few other clubs.
Cool.
Failed miserably, of course, because playing at a high level in South Australia didn't equate to a good level in the UK, unfortunately. So my uncle was over there. I was born in the UK, so I had some kind of roots there. And my uncle worked for HSBC in Canary Wharf, and he got me a job into banking because I was a bit lost, but I wanted to stay in the UK. And he got me just a kind of filing job at the Royal Bank of Canada. And when I had enough of the UK, which was pretty much one winter, and that was enough for me, came back to Adelaide. Still didn't really know, but using that 9 months banking experience before the GFC in 06, 07, managed to get a job at BT Financial Group, which was owned by Westpac. And then from there, just kind of worked up, got into a sales role within the superannuation team. And then there was an opportunity in Perth to be more of a sales executive and speak to advisors around superannuation and the products. This was in my early 20s. So I took that opportunity, single, no kind of ties, came across for what I thought was a year. And then kind of 16 years later, I'm still in Perth and no chance of moving now with kids, house and a family. But then from there, kind of grew into that and was helping advisors day in, day out with their businesses and what advice they were providing and insurance and super. And from there, in 2018, the government made some pretty significant changes to the financial planning industry where it was you needed to have a degree to become a financial advisor, which I thought was a great idea because before that it was kind of a diploma, which you could knock out in a few months if you really wanted to. Yeah. And then advising on people's life savings. So potentially, and we wanted the industry to be seen as more of a profession. So it was that kind of crossroad where I was like, well, I need to kind of do this now, or I'm probably going to be in a corporate role for the rest of my life, which I chose that I didn't want to do that. So I made the jump across to financial planning 8 years ago now. And it was at that point that I knew Alex through the industry and started Everest Wealth. So my first start in financial planning was running a business as well. Yeah.
Wow. So you guys knew each other through work or something like that?
Yeah. So it was just kind of like a I was a business development manager, so it was like a BDM to Alex was an advisor at the time as an employee, and met him a number of times at functions or a few games of golf here and there and that sort of stuff. And he was looking, I was looking for a home. And then one day, I think we were playing golf and I just said to him, why don't we start our own business? Or he might have said it to me actually. I was like, laughed it off, and then I slept on it. Next morning, 7 a.m. on a Saturday, I text back and said, yeah, let's do it. And then, we haven't looked back. So, it was just kind of, we weren't mates outside of kind of the industry. We just knew each other and got along through the industry and went from there.
That's great, man. I love to hear the origin stories of like how businesses start. Now, you guys have actually been, like, you've been servicing the Rask community for a very long time. You're our biggest referral partner. Like Everest gets the most leads. You guys do so well at growing your own business and delivering a really good service. Can you give us a sense, like to people listening or watching, can you give us a sense of like where you guys are now as a business or individuals, or like however you think about it? Yeah.
So there's a few metrics we track. So probably the first one is how many people do we see every month? And that's now sitting at 85 client groups per month. So that's the amount of advice pieces that we get out to the public. So 85 statements of advice per month. And that's all new business. So they're all new people that come and see us.
Which for people that aren't familiar, that's enormous. Yeah, that's really big.
So we've got 10 advisors, including myself and Alex, 60 staff. In pretty much every state in Australia, there's someone that works for us. We've got 2 offices, Melbourne and Perth. So that's kind of where we're at the moment.
Did you think it would get to where it is?
No, never. I guess if you asked me like 7 years ago, would we have 20 people today? I would have laughed, like said, no chance.
Yeah.
Alex and myself always joke about it. After about year 1, after we hired our first or second person, we said 10 people will probably be a nice level. Let's aim for that and cap it at that. No way would we want any more than that. So we kind of joke about that now that we're 6 times where we kind of aim to be. But it's also hard, like in the day-to-day, because we're making those decisions, we know where we're going. So it's not a surprise at the same time. So, but if in hindsight, if you look back and say 3 years ago, you'd have 60 people and do 85 pieces of advice per month, I would not believe you for sure.
Wow. So I had a couple of questions here that I wanted to ask you. Maybe the first one is just a simple one for people that are listening that haven't heard of Everest before. What type of financial advice do you do?
Yep. So we provide holistic financial advice. So what does that mean? So effectively anything like superannuation, insurance, cash flow, debt planning, investment, provide advice around kind of tax strategies to do with property. Yep. So it's kind of anything that anyone wants advice in. Now, some people get some of that. Some people need all help in all areas. So it's holistic advice, but where at the demographic we really focus on at Everest is people under the age of 50.
Yep.
So we want to help and empower younger Australians get ahead earlier in their lives. That's kind of what we strive to do.
Yeah. Is the majority of what you do like once-off types of advice? Is that how it works?
Yeah, most of the time. Probably about 70% of our clients are one-off advice. That's just kind of where we started. But now we're starting to see people come back to us and now need more ongoing help. So that is also an area of our business that is fastly growing, which is the ongoing side of our business, because now people need it. So we've got a service offering there, but it's definitely, they're not pigeonholed into our clients you have to be an ongoing client or you have to be a one-off only client. There is 2 offerings there. Yeah,
it's actually really appealing, I think, for our community in particular, because a lot of them do want to, well, they've never kind of been to a financial advisor before. So the first time they go, they might want that kind of like, give me some validation, give me the financial plan, and then let me go from there. But then they come back and they're like, actually, you guys can do it for me kind of thing.
Yeah, absolutely. And I guess a lot of people that come from your community have a lot of knowledge already because they've listened to your podcast for so long. So yeah, like you said, they want that validation and just making sure that they're doing the right thing, or I know enough, but not that much. So I just need that help to get me to that. But once I'm there, I'll take the reins back and I'll know how to manage it. So it's a lot of that as well. And it suits so many people.
Yeah. And you guys also serve like She's in the Money community, Money, Equity Mates. Yeah, a lot. So a lot of communities that, Everest represents, which is great. I was going to ask you, because we've already talked a bit about the business side of things. I do want to just ask a couple more questions there, but then we'll get into some community questions about financial planning and people here talking about tax on superannuation. I wanted to ask you, just for people that maybe a bit more entrepreneurial, Scott, like people that you deal with a lot every day would be people that are sole traders or people that are thinking of going into business, maybe they've got side hustles, all that sort of stuff. Given where you are now and the lessons you've learned, I'd wondered if you were giving someone that was at that inception stage of business some advice on business specifically, what would it be?
Yeah, so there's probably a few points. The first one would be just to dive in and try as early as possible within reason, and not wait. Do see a lot of people that procrastinate quite a bit. And then that kind of slips away, and then they have young families and it's just not viable financially for them to try that business anymore. So I guess that's probably is trying to empower people to start early and not be afraid of failing. I guess as well, if you are starting a business, just to have some form of foundation behind you. So for myself, at the time I was single, so that's a bit easier. I had a mortgage though. I only had 20 grand in the bank, and it was a bit scary to quit a six-figure job to have zero money coming in when you've got a mortgage commitment and only $20,000 in the bank at the time. So what I did was I was really keen to give this a crack, and I kind of went into the mentality of, well, if it fails, I'll just go and get another corporate job. Like that's my base. And so what I did at the time was take out as much debt as I could. So I've got that buffer, so I would never be stressed or make business decisions from a financial stress point of view. And at the time, I couldn't refinance the house. There was no equity in it because I bought in 2014 and it went flat in Perth for ages. So there was no equity. So not financial advice that I would give all the time, but I took out as much credit cards as I could. Didn't end up using them. But I had that buffer of $30,000 in credit cards that I could call upon, knowing that if I did, that would prolong my chance of trying to get this business up and going. But thankfully, I didn't need to. So I guess where I'm going with that is just having some form of foundations, whether it's a loan from family, whether it's some equity that you take out and you stick in redraw in the mortgage, just so you're not making stress decisions or compromising your vision and potentially discounting someone because you're like, I need this sale. Just trying to have those foundations and starting as early as possible is really what I would say.
That's a really amazing advice, my man. It's fascinating. I don't think people realize, well, people would realize this actually in their personal finances, is that when you're in a stressed financial situation, you just scratching and clawing for a win, right? And sometimes that win is a win in the short term, and in the long term, it's a real negative. And so having the optionality that comes from the firepower that you've got in your wallet, so to speak, that gives you the potential to really think, well, what's 3 months, 6 months, 12 months ahead from now? Whereas if you don't have that, you're thinking myopic, like I've got to solve this problem. It's here and now. It's a fire. I need to put it out. So that's really good advice. I actually listened to an interview with Patrick Collison, who's one of the founders of Stripe. It was 11 years ago, actually. I listened to it on the weekend. And in that, he was thinking, I have this philosophy about business that for every, month or year that you're in business, that's how far out into the future you should be looking. He'd be like, we're in business for 6 months, so we think 6 months ahead. We're in business for 2 years, we think 2 years ahead. And I thought to myself when he was saying that, I was like, I wish I had the ability to do that. I was just trying to like maybe like yourself, I was just like here and now, a bit scrappy. Still am in many ways. So I think that's great advice to get that foundation underneath people. I I do have quite a few questions here, Scott, from the community. So I'm going to read out the general advice disclaimer, which is, we don't know your needs, goals, or objectives. So as we answer your questions, please remember that they are general in nature. If you do need personal advice, you should speak to a financial planner who is licensed. You can verify someone's license on the MoneySmart website. It's moneysmart.gov.au. You can also head to the link in your podcast player or in YouTube in the description, and you can get matched with a financial planner. Everest is one of our referral partners, as I've already mentioned. They do a great job for our community. So don't act on the information until you've spoken to your financial planner. And if we do mention like super funds and insurance and all that stuff, they come with something called a PDS, so make sure you read that. Okay, the first question, mate, comes from someone called Health Professional. Now, I included this because I'm pretty sure, I could be mistaken, I'm pretty sure you guys had a massive focus on health professionals in the early days of Everest.
Yep.
So when this person came through with the question and name of health professional, I thought I'd ask you this one. So with all of the changes to tax and superannuation, they say, is it still a smart idea for me to buy a commercial property within super to use for my business? Or should I look at a trust instead? Now, this is quite a technical question. It's quite a significant financial question. So let's start with maybe like buying commercial property in super. What does that mean? Why do people do it?
Yeah. So buying commercial property is potentially a good option because, again, it diversifies away from residential real estate as well as the share market. So that at a high level tends to make sense. Commercial property, though, you tend to need more money to enter, depending on what the commercial property is, but it tends to be higher than most resi places on a like-for-like. Why do people do it within super? A lot of the time it's the tax rate. So as we know, superannuation, 15% on growth in earnings. If it's under 3 mil, with obviously the new kind of the tax changes. But then when you're in pension phase, 0%. And the benefit of a business owner buying commercial property is the rent that the business pays goes into the self-managed super fund that then pays the potential mortgage to the bank. So you're effectively, as a business owner, you're not paying rent to someone else. You're paying rent to yourself, another entity, but to yourself, that then pays that loan, assuming there's a loan.
Yeah.
So that's where it's attractive if you're going to own a commercial space and in your business for some time. I guess if I relate that to Everest, we haven't done that, Alex and myself, because we just don't know how big we're going to get or where we're going. So we've changed office about 3 or 4 times. So if we, in year 1 or 2, opened a self-managed super fund, bought a commercial premises, we would have had to have moved out of that, and then maybe we couldn't have rented out that afterwards, as an example. So
had to get one 6 times the size.
Yeah, exactly.
Yeah.
So definitely a good idea. Now, I think the question was comparing it to a trust.
Yeah.
Right. Yeah. So I guess it depends. A trust will give you more flexibility with the money. You can then use equity to leverage further if that's the plan. Whereas within a self-managed super fund, it's going to be a bit more restrictive, the lending terms. So it depends what you're doing it for. Interest rates tend to be higher in a self-managed super funds as well. So there's all of that you need to take into account. But on the surface, if you're looking at the tax rates, self-managed super fund will always be better most of the time than a discretionary trust. Because if it's a healthcare professional, I'm going to assume they're a surgeon or a doctor or a anaesthetist, probably on top marginal tax bracket. I imagine they're probably pushing money to their spouse, so both are already on the top marginal tax bracket. So any income, positive income that generates, or you sell the property, it's still going to come at a higher tax rate than 10% for a capital gains in super, or 0% potentially if it's in pension phase.
Yeah. So I like that answer. I've got a few follow-ups. So for people's benefit, if in order to buy a property with your superannuation, you need a self-managed super fund. So you have to establish a self-managed super fund, or SMSF, to then buy the property. Is it common that in your demographic at Everest that many people have SMSFs?
It's not that common. And more times than not, we've closed self-managed super funds than open them.
Yeah, right.
Because a lot of the time we have seen self-managed super funds with, say, $100,000 in there, and it's just a share portfolio. Yeah. You can do that much cheaper on a normal platform and replicate the share portfolio, still have control and ownership, but just lose the risk of having a self-managed super fund.
Because they cost money to set up and do ongoing maintenance and all that sort of stuff.
And the audit fees, the tax return, that's all on you. And also there's a huge risk. If you make a wrong move, there's potential large penalties. So the clients we have done it for have been that exact example where it's, I run my own business, whether it's a construction business and they need a warehouse, whether it's a doctor needing surgery, dentist is a common one that we've dealt with. That makes sense. But you do need a level of money in your super. You can't do it with $50,000 because the banks will tend to need a 30% down payment or deposit before they'll lend you the money. So you tend to need a lot of money. The downside then is your super is solely reliant on one asset in a lot of cases. So it's important then to try and build diversification.
Yeah. Good answer, mate. Great answer. This one's an interesting one. It's one that we get a lot, particularly this time of year. Are there any good accountants left? And that's the questioner's name. They say, hi there. Thanks for your 5 questions to ask your accountant. Just wondering whether you have any recommendations of any great creative accountants in Australia. They say, ? I live on the Mornington Peninsula here in Victoria, but am open to tally or online appointments. So I guess maybe 1, do you know any accountants on the Mornington Peninsula? But 2 is, what do you look for in an accountant?
Yeah, I'd like to. I heard it's a great place to go. But what do I look for? So I guess what I would be looking for myself would be someone that's have good recommendations or someone that I really trust has had a good experience in a similar situation to me. So for me, someone that runs a business and has gone to that accountant and they've had really positive feedback and outcomes. So that's kind of what I look for there. What I would look for though is similar to how we run a business because it's another professional services. So someone gives you time of day at the start. It's not, here, fill in a form, come see us, pay $300-400 and we'll do your tax. Like someone that at least will jump on a phone call 5-10 minutes, have a chat with you just to understand your situation. Yep, this is who we are. This is how we work. Just so you can just see if you get a good vibe with them as well. So that's probably 2 areas. In terms of finding a good accountant, I know some in WA, so that's easy. But it would be using like your channels or a post up in the community page if you're looking for someone in person, and just making sure you specify what your position is. Is it just I need a simple kind of PAYG tax return, or else I've got an investment property, someone that helps with that, business, and just see what the responses are. And I guess then just making sure that you're careful because sometimes some of the networking groups will jump on and just like post their kind of favored person and they've never gone to that person. So just kind of trying to see through that, which is obviously difficult, but using like people like yourself, Owen, or Facebook groups to find it. Trusted person.
How long would it take if I was to go and, book in to meet someone from Everest to the time that I get the financial advice? What's the turnaround time?
Yeah. So from when you want to see us, 5 weeks for our initial meeting. Yep. And then from if you agree, because there's no obligation, that's no cost to you for that meeting. Then if you agree to go ahead, 6 to 8 weeks from start to finish.
Yeah, so it's pretty typical, like say 3 months, say thereabouts. I use this as a good benchmark for like how good the financial planner might be because in the firm, because most of the good financial planners are busy, right? But in accounting, I found that most of the good accountants are super busy. Like it's particularly people that understand investing, like people with side hustles or businesses. Like it can be like a long wait time to find someone like that. So I can certainly appreciate where this person's coming from. And I don't know anyone on the Mornington Peninsula for what it's worth, but I'm very open to using professionals online because I just think, why limit yourself geographically? Just find the best person for you. The Tax Practitioners Board, for anyone that's listening, the Tax Practitioners Board is like the official register. So we talk about Money Smart and the Financial Advice Register. There's the Tax Practitioners Board for folks that want to verify their accountant over there as well, which is a good step to take. So 2 more questions. The next one comes from Kinda Clueless, but I don't think they are kinda clueless. I think this is a good question. It's probably my favorite for the day. I have about $900,000 in super, they say, and my wife's account is almost empty. So I'm assuming it's a he and a she. He's got 900K and she's almost empty. I'm hearing about balancing. Why is this a thing? What do I gain from balancing and preferentially loading her super? They say. So big super balance, Scott. Empty super balance. We do talk a lot about like equalizing super. Why is that a thing?
Yeah. So probably two reasons. The main one is, well, in the past, the main one has been the transfer balance cap. So when you reach preservation age, you can move your superannuation, your accumulation, to an account-based pension or pension phase. So for most people, that's going to be 60 or and above, or 60 and above when they retire, or 65 and above if they're still working. The benefit of that is you're moving your money from an environment that pays tax at 15% to an environment that pays tax at 0%. Okay. Now that limit is $2 million in this financial year. So if this husband, say, still has 10 years to go, there's a real chance that they'll go over that $2 million. Now it is indexed, so maybe that indexation will keep pace.
But if they're contributing extra, then they might add more.
Yeah,
right?
Absolutely. So then you'll get a situation where the husband will maybe only be able to move at the moment, $2 million across, and then have to leave the residual amount in super paying 15% tax. When if it had have been split off to the wife, they could have both had money, all their money could have been in a 0% tax environment. So that's the main reason. What's come to fruition more recently is Division 296, which is this $3 million cap on, and if your balance is higher than that, then there's unrealized tax on earnings. Now, that's not indexed, so that's the potential big issue here. A lot of it's going to be down to this person's age. If they're 65 already, you're probably not going to reach any of these caps because you're going to start drawing down on it and it's probably not going to grow enough to reach. But if we assume this person's maybe 45, 50, there's a real potential that you'll go over the transfer balance cap, but you'll also go over the $3 million cap. So then it is kind of two-pronged to be important to consider moving some money to your wife's account in time. Yeah,
that's a good point. It relates to the one earlier on about the health professional with the commercial property. There are those caps, which is, I'm glad you brought up. These proposed 296, which for people with larger balances is pretty significant, particularly if the government doesn't index, like doesn't increase that amount. I would add some extra ones in here. If your wife's got a smaller balance, and feel free to correct me if I'm wrong, Scott, but if you've got a smaller balance, you can add extra. You can use catch-up contributions, which may include a tax deduction. So that's great news for higher income earners. Then there's like the behavioral side of things too, which is you can have, her feeling more, empowered and having more money, which is fantastic. Then later in life, let's say they are 65 and he's 65, she's 60, for example. Yeah. He switches it on, goes to pension phase. He's got it tax-free. He could withdraw, put more money in hers, and then he might become eligible for the age pension in a couple of years.
Called kind of sheltering.
Yeah. Yep. So then there's like a bit of a deflection there. So this is where you need to get financial advice, kind of clueless, because you might be like, I'm doing a pretty good thing here. I got some good assets, but even just little changes like that from a financial advisor could way more than pay for the cost of the financial advice. So I would definitely investigate that. Kind of clues. Good question, though.
Yeah, absolutely. Great question. If you've got time on your side, there's ways that you can start to move the money through super splitting, and you split your contributions to, in this case, the wife. And then, like you said, when you reach age 60, if you meet a condition of release, pull out a certain amount of money, bring forward catch-up contribution, non-concessional, and get potentially 360 grand into the wife's account. If we assume she's not working at the moment, then potentially you wouldn't do the catch-up concessional contributions. But if she is working, then funnel the money there for sure. There's plenty of ways you can do to equalize it. Yeah. But absolutely makes sense.
I actually come across other ideas recently is like sometimes people want to stagger their retirement. So they want like not full retirement. They want, there's he and she, and maybe not in this situation, but want like a semi-retirement and where they work 2 days a week. And if he's the older one, assuming, triggers that condition of release and can start to draw some income out. So they can afford to go from 5 days a week work to 3 days a week work. And then once she is able to access her superannuation, then they can go full retirement because then they can afford it. So you can kind of stagger things as well and use the ages to their advantage. Great question. Now we're going to finish with a bit of a fun name. Willie D. Spicy McGee writes in, Scott, and they say, credit scores worth it for someone in Australia wanting to increase the chances of being eligible for loans, etc.? I hear from some that it's not as important here and that it's more of an American thing, but others say the credit cards and credit scores are important. I am someone who would rather not have a credit card if I did not need one. Now, we just heard that you may have had them as a backup and contingency. And for what it's worth, I've done the same. You know, I've had the credit cards as a backup and contingency. And I know it's not worth it, but I do love some Virgin Velocity points. So there's all the math around that not being worth it, but I do like my points. So maybe it's a psychological quirk of mine. But what do you think? Are credit scores worth it?
Credit scores are worth it, absolutely. But getting credit cards to increase your credit score is more of a US-based thing. If you've never had debt before, that's a good thing. Banks still look at that as a good thing, as long as you're paying your bills on time and you're not going into arrears on like your phone bill or your gas or electricity bill. So that's what I would focus more on, is just making sure, I'm paying my bills on time, I'm doing good, I'm steering clear of your afterpays and that. I'm not doing the buy now, pay later stuff, but I pay my bills on time and you'll be fine.
Yeah.
And if you're ever worried, just get in touch with a mortgage broker. Say, look, I'm looking at buying a house in the next couple of years. Any good mortgage broker will give you a time of day to let you know where you're at and what you need to do if it is kind of not a good score at the moment.
Yeah. It's actually an interesting point you raised, because I find that in the Australian system, it's like a negative scoring system. Like we get penalized, whereas in America, they're very focused on getting a high score because it enables them to access whatever. Whereas here, it's kind of like when you go to do a check, like people would be familiar with this if you go for like a personal loan or maybe even a credit card or a mortgage. Basically, the test is, are they credit worthy? Yes or no. Whereas in the United States, it's like they actually take into account so much more around the actual score being indicative of that person's credit, to the effect that even friends of mine moved to LA not too long ago, Scott, and they went for a rental property. But because they didn't have a credit score in the United States, the rental system over there is actually designed that it uses your credit score to determine if you can get a rental property. So they didn't. So they had to like move through houses and they had to get a credit card just for 3 months to prove that they could get the score to then get the rental, which was a bit like, it was full on for them because they got a young one or two. So it was pretty hectic. But here in Australia, fortunately, we don't have that issue as much. And you mentioned buy now, pay laters. The mortgage brokers always ask about that. HEX debts are another one. It's not like a bad thing. It's just, it does affect your eligibility for like borrowing power.
Yeah,
so
how much you can borrow. So just pay your bills on time, try and reduce any credit card, personal loans, buy now, pay later, and just steer clear of that and you'll be fine. Yeah.
Yeah, cool. So just to recap these questions, I do have one final question for you, my man. We've got a health professional asks about tax on superannuation and commercial properties. There are those rules that Scott alluded to, but generally speaking, a pretty good idea if there's an alignment of like business owner, high income, that sort of a thing, but definitely get advice. That's like me chiming in there, definitely get advice on that because first of all, it's going to be costly anyway, but second of all, get it right. Really get it right. Number 2, are there any good accountants left? We feel you. Scott knows a few, so if you're an Everest client, maybe you can get a connection. But there are good accountants out there. Use your resources, go online, use the tax practitioners board. Kind of clueless, 900K in super, wondering about equalization of supers. There are so many strategies to use. Now, that's not us just having a bias, it's just there are strategies that are available. So check it out. Willie D, Spicy McGee, credit scores. Yes, they're important, as Scott alluded to. Different system here in Australia, indeed, but get in touch with a mortgage broker. If getting a home loan is what you're after, the earlier the better. Don't wait for 7 days to call your mortgage broker like I did. Not a good idea. Now, people can get financial advice by heading to the Everest Wealth website. I put a link in the show notes, but there's also a way to get matched. You can follow the link in your description, YouTube, that sort of thing. I put a link in there. It's got financial planning. Hit that and you'll be matched with a financial planner like the good team here at Everest. So this is your first time on the show, Scott, not the last time, but this is my final question. And it's one that I go and I ask all people who have come on the show for the first time, which is just a bit of advice you would give to your younger self. So if you could go back in time, what's one thing you would tell your younger self about money, finance, investing, could even be life, just any type of wisdom that you would give to a younger version of Scott?
Probably buy Bitcoin, but
yeah, that's a good one.
Well, yes, but no. So for me, I think it would be not to be scared of debt, good debt. So I grew up in a household where struggled in the early years because we immigrated from England to start again, and getting a mortgage. There's quite a bit of financial stress in the household, and paying down the mortgage was ultimately what was the only thing that happened. So that probably kind of came onto me a bit, and I delayed a house purchase, which I could have done it probably 3 years before I actually did it financially. And if I had have done that, then I would have been better off. I wouldn't have been paying rent. Interest rates were low. House price would have appreciated if I had bought when I could have bought. So yeah, what I would tell my younger self is not to be scared of sitting in debt, good debt, like a investment property or a house you live in.
Yeah, I really like that. It's a really interesting bit of introspection there, mate, because it's interesting that you could tie that to where you come from and that kind of lived experience when you were younger, and how that then kind of, pushed across into you, and you could kind of correct that, or you could recognize it at least. So that's great, mate. You've been wonderful. First time on the show. I'm really glad you took some time while you're in Melbourne to come and have a chat. So yeah, Scott, for Everest, thanks for joining me.
Awesome. Thanks, Owen. Cheers.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.